What are uncorrelated assets for true portfolio diversification? Imagine trying to balance a seesaw with objects that move together and others that stay still or move in opposite directions. That's the idea behind uncorrelated assets in a portfolio. These are investments whose returns do not follow the same pattern as traditional assets like stocks and bonds. When stock prices fall, uncorrelated assets might stay steady or even increase in value. This independence helps smooth out the ups and downs of your overall investment. In portfolio diversification, spreading your money across different types of assets reduces the risk of losing everything at once. When some assets decline, others that are uncorrelated can offset those losses. This balance makes your portfolio less volatile and more resilient during market swings. For example, if stocks drop due to economic concerns, certain bonds or real estate investments might hold their value or improve. Uncorrelated assets include a variety of options. Alternative investments like private equity, which involves investing directly in private companies, often depend on the company's performance rather than market trends. Hedge funds use different strategies to generate returns regardless of stock market movements. Real estate investments, especially commercial properties, usually relying on rental income and local demand, making them less sensitive to stock market shifts. Collectibles such as art, rare coins, or vintage cars can also be uncorrelated because their value depends on rarity and collector interest, not the economy. Government bonds, especially those issued by stable countries, tend to perform well when stocks decline, especially during economic slowdowns or falling interest rates. Litigation funding, where investors finance legal cases expecting a payout if the case wins, is another example. Its returns depend on legal outcomes, not financial markets. Recently, some have considered cryptocurrencies as uncorrelated assets, but their high volatility and increasing links to stock markets make them less reliable for diversification now. Adding uncorrelated assets to your portfolio can lower overall risk and protect your capital during downturns. They also help improve long-term returns by reducing the impact of market swings. When planning investments, it's important to analyze how each asset moves relative to others. Balancing these assets according to your risk tolerance and goals creates a more stable, well-rounded portfolio. This approach helps avoid overexposure to any one economic factor or market event, giving you a better chance at steady growth over time.